Yes, you're visible and audible.
Okay, can I just check recording is up already and all that? Everything good, right? I can start, right?
Yep,
Yeah.
already recording.
Okay. Perfect. Okay. I'll take my POIs through chat. If by 5:30 I don't take a POI, then feel free to unmute yourself. Otherwise, just please keep yourself muted. And preferably I'll take one from TG for cross engagement. Okay, I'll begin after the lines. Let's start with a definition challenge. Understand that this debate is about ownership specifically, not how much you allow for them to have decision-making calculuses. What this means is that the opening government model is already a squirrel, because this isn't about because just allowing them to keep equity and having some form of shares and ownership within the company is in and of itself squirreling emotion. This is about ownership. They have to take a harder stance. More importantly, let's do some framing, because understand that Litwin's speech was very, very convenient, because he never actually told you who were the individuals who actually took up these loans. Understand that the individuals who took up these loans aren't those that are realistically going to succeed organically. Maybe it is the case that what he talks about is right. Maybe it is the case that this debate actually impacts a lot more, like the companies that are affected a lot more are the corporations that then become very rich, become very successful, and after all the impact they talk about manifest in the first place. But the reality of things is that if these corporations were already going to organically succeed, then, and if they weren't risky, then they would have probably done other forms of alternatives in order for them to gain the funds, in order for them to start up these corporations and these businesses in the first place. That didn't require for them to give up their ownership, didn't require for them to go through a hard, long bureaucracy process, just them taking out bank loans instead. Because understand that giving up equity for the vast majority of individuals is a very hard thing for you to be able to do. You have to tell yourself that, hey, in order for me to be able to succeed, I have to give away part of my business, part of my life, part of my soul. That is something that most individuals just aren't ready to do unless it is something that's absolutely necessary. What does this mean at the end of the frame? It means that for the vast majority of individuals who go through these venture capitals, oftentimes they are the same corporations that would never have succeeded organically, because either A, their businesses were too risky for bank loans, B, they just haven't had enough good credit in order for them to access other forms of capital, but C, and most importantly, that all this means is that venture capital is their only way in order for them to be able to actually go ahead and just, gain the startup funds in order to start their businesses in the first place. So what is the problem of today's debate then? Because understand that what this means is that venture capitals are inherently a very risky business opportunity. And what this means is oftentimes they need to be able to actually diversify the amount of risk that they have across a large amount of individuals. And all this means is that it requires for them to have to actually take time, and all this means is that oftentimes these require time for them to take fruit, to bear fruit. What do these corporations look like? It looks like, for example, particularly meaningful innovations like AI. They take a while to do well, such as 50 years down the line, because the innovation of something like that is super new and no one wants to take a risk on it, but are things that require a large amount of capital and are things that are actually meaningful for our society. Because understand that these are generally the things that are the riskiest and don't actually have access to capital, but are the ones that these venture firms are willing to put money down on, because they're able to then distribute that risk basically. So what does this look like? It looks like very high cost projects that need some form of capital that is too risky, or very big innovations that take a lot of time for them to do it. So what does this mean for the incentives, or for the incentive of these venture capitals in government? What this oftentimes means are two things. Firstly, that in the government model in which you do not give them enough equity for them to be able to keep over time, that there is no incentive for them to actually give the money back to these businesses who actually take a large amount of risk. The problem here on the government side is that oftentimes these venture capitals and these venture capital businesses that you give money to just takes a very long time for them to be able to actually bear fruit. Like I said earlier in my AI analogy, it takes 50 years for you to create a new form of AI, and it's something that's highly risky. And because of that, what this oftentimes means is that the businesses that require the most amount of help, aka the businesses that are the most riskiest but the most meaningful, are those that don't even exist in the very first place on the government side. I.e., the vast majority of businesses that require venture capitals, that go to venture capitals in the first place, are the businesses that they themselves make it so that these venture equity companies just aren't willing to give money to. So at the end of this, what you have to end up believing is that oftentimes these businesses just wouldn't even exist in the first place, because they aren't even given the capital that is required for them to actually exist. And because of that, what this means is that they just don't have to get to the point of scaling in the first place. But before I continue, go ahead, CG.
Can you prove that VC firms want to hold all these businesses for like a long period of time beyond just like some speculative AI business that you're talking about?
Sure, such as them coming out with new innovations to be able to take over large forms of technologies and all. Like, understand that in general, all that you have to buy for all of these things is that these businesses are very risky. They take a lot of time in order to innovate and break the market, which is what these venture capital businesses oftentimes hope to happen. And because of that, they need a reason to be able to hold on, i.e., the fact that these equity are very long. But the second thing then is that even if they do get the initial forms of monetary income, that there is no incentive for them to top up when it is needed. What does this look like? It looks like a business that it might initially get some form of venture capital, having some form of found potential in the future later down the lines, but never getting additional tops up of money because of the fact that they know that even if you are able to succeed 20 years down the line, topping up money means nothing for them. Because all these things mean is that you don't actually get any returns on these things. So you don't A, get the initial startup capital that is required for you to succeed, but B, and most importantly, you don't get any money furthermore from that because of the fact that they find no reason to invest in you. Understand that if you buy these mechanisms, then we already beat out OG. Because Litwin's speech it's a speech about very long termist, and it only manifests if these businesses exist in the first place. It doesn't matter how much a company can potentially upscale if there is no startup in the first place. So what does outside then look like? What outside looks like is that we won't prohibit these like venture capital firms from maintaining ownership. There will still be a fixed investment period, and obviously there will still be regulations for insider trading and all the things that Litwin wants to talk about. You probably cannot go beyond a certain threshold percentage of owning the company, like 40%, so that there's no dilution of sales or any form of hostile takeover. However, in general, the reason why we are comparatively better is because when there is a longer period, there are three things. Firstly, there is more incentive to give money towards the firms that actually require venture capital the most because it is less risky. Secondly, they are more likely to top up in the events that the returns are probably going to give some form of potential. So what does this look like? It looks like the fact that, for example, even though I've invested only these venture capital firms $10,000, if I see that they've come up with a very amazing prototype that needs 20 years down, that they can only make 20 years down the line, I'm willing to put in $10,000 more because I know even after those 20 years that my 10% of equity will grow even more. 3 points of weighing under this then. Why is this important? Firstly, we can bite the bullet that maybe there will be some form of long ass bureaucracy process, but comparing this to these businesses not even existing in the first place, we tell you that for the majority of individuals who start up these businesses in the first place, i.e., the people who actually matter in this round, that they would rather have these businesses exist and having to deal with these stakeholders than not having them in the first place. Secondly, it's about the numbers of businesses help and the extent of help. That on our side of the house, we help more businesses exist, and the extent of help is much larger because they're able to give more capital. But thirdly, and most importantly, is the number of better, more meaningful innovations that take a long time to be able to take off that actually benefit our society. For all those reasons, you have to buy OO.
Thank you, Elo, for that speech. Calling on DPM. Yeah, by the way, please stop the recording.
Sorry. Just curious. Did someone stop the recording already? Because it still says recording.
Yeah, it still says recording on my end, Elo.
Hi, am I audible?
Yes, you're audible.
All right, give me a minute. Oh, let me see. Okay. Yeah, sorry. Oh my God, where's my stopwatch? Okay. Okay, found it. The first thing I want to do is to clarify who goes to a venture capital and what is given up in return for ownership. The first is the need to expand. You need to have money to put into franchises. Examples like Sponge Daddy, for example, is an effective product, but you need to set up new factories to mass produce them. But they have trouble getting money to create more Sponge Daddies. They already have an effective product, but they cannot. The second is nascent companies and new technology. So new tech like AI when it was at its nascency, and biotechnology, for example, like new stuff like HIV vaccines, for example, are the two kinds of products that exist. Note that this is not total ownership. It's owned in equity, which means that like the other things are liquid and publicly traded. This is particularly important to note because they assume that there will just be major amounts of shares in these companies. This may be true, but like there's also majority of the shares are still owned by either like the average shareholders or these individuals. The question then becomes in this debate whether like it's enough particularly to make them monopolistic. And I think the answer is no. Like just by framing alone, like I don't necessarily think you should buy the fact that like they are particularly monopolistic. But even if they are, let's just talk about what's given up in return. The first is shareholder power. So you sit on the board of shareholders and there's one more person to explain to. I'm not sure why this is a big cost, but the more important thing is that you give financial advice and capacity. So i.e. that a lot of these people still in general, like a lot of these people provide like financial bookkeeping. Like they literally like talk about your balance of payments. They provide you things like, for example, like whether you should publicly trade your company. They give you financial advice in terms of these things. Why are these companies actually lacking these things? The first is because many of them don't have like financial say. As Litwan concedes, many of them are heavily specialized in the thing that they're doing, but they're not good at bookkeeping. This is particularly important because this means that like in general, most of them don't know how to do the financial thing, which is what a lot of these companies fill in terms of the niche. The second thing specifically is that they just have no the second thing is that after they succeed, it doesn't guarantee the future success because you still need to continue to succeed even if you have a success. You need to continue to innovate even if you have a successful product, right? Unless the product is so good to the point that everyone needs to use it, which is not majority of like the products that are being created through VC firms. This also means that they often tunnel vision, right? They make bad financial choices. So this also means that they oftentimes like do really stupid shit, like mismanage their funds. But lastly, they also want to be uncompetitive. The incentive to be uncompetitive exists on both sides of the house. So this debate surely cannot be about insulin because on both sides of the house, even if you're a small or big company, if you are a producer of insulin, you will want to price gouge anyways. This debate is like, it's not unique to VC firms, nor is it unique to small firms. If you have something which is so important to the point that like you will gouge prices, you'll do it on either side of the house. This is uncomparative. Why is this particular thing important? The first is that I'm showing you why specifically these why these VC firms need why these VC firms are integral towards the financial health specifically of these companies, both in the short and in the long term. And it's something that currently your nascent companies lack. But the second thing is that it's extremely risky even after you invest without ownership. So you have to see the train wreck happen and you can do nothing to stop it. That's the biggest problem that they currently have on their side of the house. Before I move on to why specifically the model doesn't work, I'll take closing government.
So after 10 years, you don't know how to bookkeep, man?
Yes, correct. Because after these 10 years specifically, most of the bookkeeping has already been outsourced to the venture capitalists anyways. But also, as your opening points out, if you want to knife them, you can. Is that a lot of them are specialized in the thing that they do, but not specifically bookkeeping. That's the main thing that they know how to do. Next thing, in terms of the benefits, in terms of whether to invest, the model is that they'll downgrade the shares and you'll keep the stake, but you'll downgrade the ownership. What they're trying to do here is to suggest that there is a monetary incentive sale. You just don't have no say. But the first problem is actually the value is not by the increase in value of stake, but through management. The first is that these companies often rely on these firms to check their bank accounts. It's a main contribution, but not only money, but it's also expertise as well. But the second thing is on the counterfactual that these companies have no incentive to make financially good decisions. But the second thing is that they can continue to develop new products, i.e. that they cannot if you see like an investment opportunity specifically, right, that exists, like you have no ability to like tell them that you want to pivot there, especially when smaller companies are risk averse, right? And they don't want, and this is important, this is opening government characterization. Here's the thing. PE companies are less risk averse to innovate more because smaller companies, either on their own or like after they leave, are still small by nature and have stopped a lot of funding. This means that they themselves don't want to innovate more because to innovate more costs a lot of money. But the comparative here is that owning these products means that they want to dictate and move towards these bigger like move towards like innovating more products to begin with. The comparative is that either can't or you have no incentive to do so. Therefore, they're more likely to want to take riskier decisions to want to innovate. This flips their claim. Lastly, ownership is tied to stake. You cannot hold stake and not have a say. Like just inextricably tied. You can't hold 50% stakes and pay installments. But even if you can pay installments, that's not the point, right? The point being that they want these companies to succeed in the long term, like, and they want to be able to have a say so that like this investment continues to accrue. Here's the illustration. If you have a say in the company and you can guarantee that the company continues to exist, and there's continued innovation, you get more returns. The comparative here is that the company makes bad decisions because you don't have a say in them. And then like you may have either short-term investments in general that can maybe accrue for another 4 more years, but in the long term, they either collapse because of financial mismanagement or they don't innovate, so it stagnates. Either ways, the first impact is that you're likely to, or it's very likely that this ownership is particularly important in their incentive to want to stay in these companies. It's not the money they get because they get from other sources and bigger companies anyways, but it's specifically in the kind of specialization that they are able to talk about. The second is, like, there are other alternatives specifically that they can invest in. What makes these small firms particularly good to invest in is precisely the huge amount of stake. That's the main way that they compete against larger firms. The problem with GAF as well is that they're uncomparative. You can invest also in a bigger firm and be a lot safer, right? But the reason you take on more risk to begin with is because you can control that risk. Therefore, this is the main difference between wanting to invest in a big firm and a small firm. This shifts the decision-making calculi. If you are able to get investments and like money, you just invest in Apple. But the main change that happens here is that you're able to like dictate basically like the much amount of money and like say and reduce the risk significantly. This is what's unique to this particular to this like ownership thing. The second, even if the money is small, again, it's short term, it's not lasting. Lastly, they talk about like VCs don't want to support IPOs. I want to play ball here. They don't analyze the incentive of PE firms. There's 2 ways to make money. The first is to take out the bad eggs in investment and redirect them from failing firms. Yahoo Direct specifically was failing because they weren't investing in the correct tech parts. When they redirected it towards like fantasy sports and whatever, Yahoo started to become significantly better. This meant that you're able to trade these companies locally, so you have an incentive for them to succeed. The second is to make them publicly traded, which can only happen if you're certain that someone wants to take up the company and they're healthy enough. Either way you slice it, there's an incentive to succeed, but the comparative is that they have no incentive to succeed and they make financially bad decisions, which prevents them from earning money to begin with. All these reasons, opening opposition.
Thank you, Yellow, for that speech. Calling on member of Gov.
Am I visible and audible?
Yep, you're visible and audible.
Orb wants us to believe billion-dollar investors can't let go because founders apparently still need help doing their books. Let's be clear. That's not a defense of the status quo. That's proof that the longer in which VC firms can hold these companies, they don't do fuck all for these companies in the long term, as opposed to equipping them with the specialties and the resources that they need at the early stages of that investment. The first thing I want to frame here is what opening missed. OG is right that VC overstay hurts IPOs and things like stunts growth, but they only look at it at the company level. I don't think they particularly explain how changing the ownership cycle transforms entire innovation ecosystem, which is exactly what venture capitalist firms are for. But exaggerates investment flight. They ignore number one, VC funds already operate on 10-year life cycles, therefore they regularly return capital to investors by this point. Secondly, late-stage growth capital is a different animal entirely. It doesn't rely on your venture capitalist firm staying forever. It requires different pools of funding that we will prove to you. But thirdly, most moonshot projects still reach commercial stages in 10 years. Look at Uber at its infant stage. Look at Tesla, like Airbnb and stuff like that. I have 2 either isolated responses. The first is, if you cap ownership, VCs won't invest in risky projects. projects. This ignores that VCs already operate on the 10-year life cycles that I talked to you about. But what we need at a late stage, what we need in terms of late stage capital is things like private equity, it's things like growth funds, it's things like strategic buyers. These are all the firms that are willing to take on mature companies after the VC exits. The point in which I prove this, I'm already giving you an alternative as to why these companies won't just be left in shit at the point at which they leave, already taking it over opening government, because this is one question that they don't answer opening opposition on, even if I think OG is really clearly taking up OO of this debate. Our entrance then is not just about whether one company grows, it's about whether the system is able to keep producing winners decade after decade of innovation cycles. And we will prove, one, more net innovation, two, why we get healthier market competition, and three, why we just get higher capital efficiency. The first extension then is why VC firms themselves are better off letting go. Like, just let go of these poor companies who have given you some right years ago, and now you still want to hold on because you want to milk them like a cash cow. The current harm is VCs often hold on to these winners for 15 to 20 years. Look at all the kinds of different VC firms that has existed throughout history, things like Uber, things like Tesla, etc. What this creates is a zombie capital environment where you have billions of dollars that is locked in one mature company instead of funding hundreds of early stage ventures across different cycles. Imagine if you have $2 billion stuck in a 15-year-old, I don't know, Uber app or something like that. That's like at least 200 or 2,000 seed stage startups that never get a chance to operate on your side of the house. The mechanism on our model then is that when you have a 10-year limit, this firstly forces that VC to cash out and reinvest. But secondarily, what earlier exits mean is three things. Firstly, you have faster returns for your VC investors, so more money for their pension funds, more money for their university endowments or whatever. Secondly, you have more opportunities to back new founders now, so you create that recycling of capital within the market. But thirdly, the VC's brand benefit from a bigger portfolio hit rate because you're not just putting all your eggs in one basket. So more companies will want to come to you because they know you are able to have their best interest, especially at that phase, that infancy stage of their company. The positive impacts then is threefold. Firstly, even 20% of VC money that is currently stuck in these zombie capital firms are able to rotate out annually, that's billions flowing into AI, billions flowing into biotech and green technology, which are the industries with massive and social economic upside, like what opening opposition talks about. But secondly, on global competitiveness, countries with fast capital cycles become the place to raise that money, because that is the point at which you're able to attract both founders and things like international investors to these particular countries. But thirdly, you just get more VC sustainability because you're able to be more diverse as opposed to putting all your eggs in one basket. Three metrics that we've been on here. Firstly is innovation volume. OG focuses on deepening one company's particular growth. We create hundreds more companies over time. Secondly is capital efficiency. OO's fear of losing capital ignores that freed up money makes you much richer, so you can invest overall. So if the incentive of these companies are to get rich, we maximize that with this prohibition. But even if one moonshot needs exceeds 10 years, the lost upside from that particular moonshot projects, because it's taking a slow burn, is outweighed by the upside of funding dozens more fast-growing firms. So maybe we lose out on some innovation, but that's okay, because we can spread these resources through a larger pool of companies that are more likely to succeed then. I want to just then very quickly weigh out what OO says in terms of VC stays for bookkeeping and finances. Firstly, if a company still needs its VC to do basic bookkeeping after 10 years, that's a damning sign of managerial incompetence. But the first few years of VC involvement are precisely when they bring in your CFOs, when they bring in your accounting systems and your officers and stuff like that that work in these particular departments. These are not like mystical skills that take a decade to transfer. An accounting degree also take 4 years only. What the fuck you teaching the guy 10 years for? These are literally plug and play functions that competent founders can adopt in literally months and not decades. But secondly, even if some companies are genuinely struggling with financial operations, number one, that's why we create post-exit support. Nothing in our model stops this VC from providing advisory services and non-equity consulting after that, but we also increase that, the channel of funds that you have to other growth efforts, other specialist firms, right, which are able to help you with your finances and things like that in a more nuanced way. But thirdly, we get more capital rotation. The marginal benefit of hand-holding a founder's finances is tiny compared to the massive opportunity cost of trapping billions in this one particular company. Before I move on to the second extension of how we are able to break VC monopolies, go your last chance to redeem yourself.
If your OG says that you're rich, why are the three companies we forgo something which is so significant?
Sorry, can you repeat that?
If your OG says that VCs are very rich, why are the three companies we forgo something which is so deadly to them?
If the OG says the VC companies are so rich, why is the three companies you forgo so deadly to them? Exactly. It's not deadly to forego these three companies. I don't get what this POI is trying to prove. The first part of this extension on breaking monopolies is on the current harm. When a VC holds a dominant player indefinitely, number one, they shape the market to protect the player. Two, they funnel partnerships, media coverage, and spotlighting and talent towards this particular company. And they crowd out new entries to these markets completely. The mechanism and our model allows us to loosen this chokehold. Firstly, one that we borrow from opening government by way of IPO, where ownership spreads to thousands of investors, but two more additional ways. Firstly, by acquisition, because you might have a new parent company that can spin off a few divisions, creating competitions amongst these different companies. But your VC also moves on to back competitors in the same space, right? What this leads to is not just one VC firm dominating and therefore this monopoly trickling down to the company that they're benefiting. It is a healthy overall competitive environment for these firms to progress in a safer way. The weighing here is simple. Firstly, on market competition, OG's company level growth can still happen under monopoly conditions, which slows down your overall innovation. We prevent those monopolies from happening. But secondly, OO's defense of patient capital ignores that patience for one giant means starvation for dozens of other small players. We win on the scale of benefit. We win on the sustainability of these VC firms and their ability to continuously provide for nascent industries and companies. But thirdly, we just have market health because we prevent monopolization. I mean, we lost to NUS when they said monopolization is bad. They should win the debate.
Thank you, MG, for that speech. Calling on Emma.
All right. This is good. Hello? Hello?
Oh, sorry. I misheard. Yes, you're audible and visible.
Two contributions. First, a characterization of when the selling happens, and secondly, who will the selling go to? The first, when the selling happens. Because the problem with GovBench thus far is they don't explain why specifically we need to force the selling out. Because independent of fixed investment periods, VC firms have natural incentives to exit their investment for three reasons. One, because selling their current ownership in the startup frees up capital for the VC to redirect their money into new startups, because as opening government identifies, they want to actively diversify their portfolio. Second, because if the industry that your startup is in high demand and strategic buyers, as CG points out, are looking to buy your company, then you will cash out regardless, because if those guys are able to provide more expertise to launch the startup to a greater level than the VC firm is able to do, then that startup is likely to be valued very highly, and thus you seek to gain more by selling it than by retaining it. For example, if Shopee, because e-commerce in Southeast Asia is looking to grow, and you know the strategic buyer can provide more value to it, then you will sell it out because you know there's so much money to be gained to selling it out. But thirdly, if you grow a startup to a multi-million-dollar business, it doesn't actually matter unless you sell the startup to prove your realized gains. And its realized gains is what grants these VC firms more credibility. So the implication of this framing explains that if the GovBench claim is we want the VCs to sell off the startup so they can enter the public market, they'll do it on both sides. So if they don't sell the startup, they have pretty strong reasons for doing so. So opening opposition stops at saying they hold on to it because of long-term incentives, which are fair, but this is only applicable to a very select few companies, which require more than 10 years to have really moonshot types of innovations, or that it's not explained why we necessarily need to hold on to this long period. Our explanation is that their side then forces an unnatural and premature exit from the ownership of this startup. And once this happens, there are two possible situations. The first one is that VC firms are encouraged to engage in extractive behavior for how they hold the ownership of these companies, what decisions they vote on, and so on. So it's no secret that PE firms are known to do things like cutting costs by restructuring companies, by laying off workers, and for example, having less money going to health and safety standards and innovation and whatnot, because they know this brings uncertain costs and investment that you could otherwise just save on, and therefore increase the profits. And the implication of this is quite bad. First, just on people who are attached to these industries. So if you're someone who's working in the company or you're having some form of a strategic partnership with the startup, you are someone who loses out if the VC firm engages in this type of asset stripping and extractive behavior, because people lose their jobs, people lose the innovation into things that could have otherwise gone into some type of integration with other startups in the same field. So obviously this is bad for people who are employed in those things, a dimension of the debate that no one touches on, but also bad for innovation per CG's own metric. But secondly, this is also bad because it means that once the startup is fully extracted as such, when it goes onto the market, this means that it has lower value. And so the comparative is that it's plausible that VC firms want to do this on either side. But the problem is that their side unlocks a unique incentive to engage in predominantly bad behavior over good behavior, because you know for sure that after the 10-year period, you no longer feel any of the harms that you put onto the startup, as opposed to if the startup is always going to be with you, or at least the strategic ambiguity for how long you hold onto the startup. That's when it forces the people who are in charge of the VC to engage in more responsible behavior instead, because you don't know for sure when exactly you're going to sell off. And if you are going to sell off, that's when you know for sure that you have to actually engage in proper management of the startup, because it's possible that no one will buy the startup if you hold on to it for too long and you do bad stuff, as opposed to on the other side, where you for sure have to sell off the startup. Now, open government claims that there's less transparency because there's no reports and so on, but that's exactly why they can engage in these types of bad asset management, because they know for sure that they'll have to sell it off, and therefore they can just gain whatever money they have through the 10-year period. But at the end of the 10-year period, they just gain whatever money they have at the sale of the startup, and therefore they earn as much money as possible out of this, which has bad implications on the startup. The second possible scenario is that VC firms are forced to sell off their stake during periods of poor market conditions. And note, there's nothing in the setup provided thus far to explain how they would deal with cases where, it's just, we don't really want to sell right now. Because the problem is markets go through natural periods of high and low. And the issue is that if the point of the investment period being over coincides with a bad market condition, such as a recession, or which is often quite highly likely in the world today, this often means that this startup is going to be highly undervalued. And as a result of this, less and less people are going to be buying the startup, which forces, continuously deflates the value of the startup further, which means people who have their equity, aside from the 20% that are owned by the VC, are also going to lose out money, which is bad. The comparative on our side is that you can weather through periods of bad economic conditions, because they know as the VC, don't have to prematurely sell it off. You can wait until market conditions recorrect. And as open government's framing is true, they can force to weather through these bad they can diversify. Why does this beat opening opposition? Because as CG accurately points out, OO's reason for why the startup should be owned by the VC specifically is a little bit strange. You probably don't need the bookkeeping expertise after 10 years. Our extension is far more significant, that VCs are needed to weather through periods of growth where otherwise they don't necessarily want to sell it out just yet, and we're selling it out will force bad behavior, and also to weather through poor market conditions. This explains why VCs specifically should be the ones who have long-term ownership. Secondly, who will acquire? So some credit to CG for explaining who they will do this. But I think the problem with this is that this is presuming that they are going to have the same value as previously they were. Because the thing about PEs and strategic buyers and whatnot is they can buy lots of different things. So if the value of the ownership of the equity goes down per the mechanisms I gave just now, that means they won't buy this, they'll buy other stuff. So when the value of them is really low, who are the ones going to be coming to buy in? Before that, I'll take OG.
Yeah, our fiat model still allows them to hold stock in the company, but even then, your MEC hurts the business model of VC firms because it shows they're predatory and destroy businesses, so they won't be trusted with that capital by both the investors and the companies that they invest into.
Well, that's not true, because the VC firms are the ones who are predominantly owning in the startup. They're not huge amounts of VC firms, which means even if the few VC firms that do engage in bad behavior, they're not going to stop people having investment. Then Per also owes analysis for why the VC firms are so necessary in investing in startups. So the question then becomes, who will acquire them? It's not going to be the strategic buyers. It's going to be companies that are in the same space who have predominant market power. So because this is mostly tech companies that a lot of sites just generally agree to, things like Facebook, Amazon, really big monopolies, that will buy them out at a very low price to engage in anti-competitive market behavior. And the reason for this is because they are so large that they can absorb the cost of buying an unproductive company right now, so that they can have these levels of integration that forces out any potential future competitors. Why is this bad? The first thing here is that obviously this reduces competition, where otherwise they will, for example, force a market condition where they may force lower prices, innovate on better services and whatnot, where now they're just acquired by these big players, because even if the value of it isn't very high, they're the ones who have so much money they can afford to acquire low value companies. This is more important because the good value startups will be acquired on either side, but because we explain their side reduces the value of startups, they're acquired by bad actors who will do bad things to these startups. For those reasons, you have to oppose.
Thank you, Emma, for that speech. Calling on government whips.
Sorry, just give me a second. Huh? Am I visible and audible?
Yep, you're both visible and audible.
Okay.
Let's go, Biggie!
Thanks. So I interned at a startup a few years ago. And if what OO says is true, then it must be true that the startup that I worked for and many others would prefer to be partnered with a venture capitalist firm, post 10 years and post maturity, prefer to have a partnership with them because they're incompetent with bookkeeping, over hiring like one Vignesh intern or two Vignesh intern if need be. So the weighing for this is very simple, and this takes out a large chunk of the aid needed and the perspective of the startup company from OO. Because the weighing here is simple. The weighing is, why would a company prefer the idea of having their shares diluted, having their shares owned by a foreign entity, as opposed to hiring two interns? Even if it is impossible then for an intern to compensate all of these things, again, startups operate in very salient ways. Companies, by the time that they hit the maturity period, operate in pretty salient ways as well. They do things like partner with accounting firms to get their audits done, do things like get financial consultancies from big four firms if they're capable enough to do so. Even if none of these things are capable, simply put, the response that comes from Ahsan is simple enough to take out OO, which is post 10 years, you can't do things like bookkeeping and financially understand yourself, and you don't have departments for these things. That isn't a fault of the market or a necessity. That becomes a problem of incompetence within the individual firm. Therefore, these are companies that are likely going to survive anyways. These probably aren't the companies that VC firms hedge their bets on and see as being able to mature in ways that are probably good for them. The second call out that I have then is to the CO, which says that the problem is where you went to sell. The market situation is typically one that is bad. I want to respond on this for a few key levels. The first reason I want to respond to this is that the idea of selling when something is mature and therefore going to buy another company, for example, isn't something that guarantees against things like the uncertainty of the market and the uncertainty of when these venture capitalists are going to sell. This creates a large amount of asymmetry in the closing clash because, number one, it positions Ahsan's case as one that gives higher amounts of certainty to other startup companies. So now it looks like the AI tech firms that all teams say are really, really important, being able to know for certain that a venture capitalist firm is going to be looking for another place to venture into, the point where they can no longer invest in this earlier firm. So sure, on all sides, there is some possibility that a venture capitalist sell, but it is exclusively on GovBench, in particular CG, that the ecosystem becomes a lot better because you have a certainty that they're going to look for a new place to invest into and to diversify their portfolio. But the second reason that this is something that is bad is that it explains exclusively the harms on opposition bench. Because if it is true that the next big AI is something that we really need to invest in, CG is giving you a clear pathway towards how we get this in the first place. 3 questions I want to answer then. The first thing I want to talk about is, can a company be salient post-exit? So let's look at the individualized firm first. We say that it is better because of your capacity to innovate. We say that it is better because typically after a 10-year or whatever the agreed upon period is, you typically have the ability to branch out and like handle the finances and handle the marketing of a company. But we also say thirdly that you have the capacity in terms of logistics to handle this as well. What do they, and in particular CEO, say in return? Number one, sometimes companies don't want to sell. Number two, sometimes the market is pretty bad. Number three, that the people that are acquiring you are going to be companies like Facebook and Meta. I mean, Meta is Facebook. And then therefore, this is something that's really, really bad. I want to rebut this on a few key levels. The first, I think it's perfectly within the fiat if you're talking about financial feasibility and what is financially realistic for there to be clauses protecting against bad market situations. So for example, if we're going through an economic downturn like COVID, like we did previously, for example, with the rent freezes that we gave to people, you can do similar things whereby the venture capitalists leaving your startup is something that is delayed post-reconciliation and post-recovery in the economy. Second, simply put, the idea of this is something that's problematic because it's largely symmetric. The idea here that selling when a big buyer comes in that has the amounts of capital that Umar talks about, for example, is something that equally exists on both sides. Because if it is true that a venture capitalist wants to sell and is inherently capitalistic, then this is precisely when they have a greater incentive to sell because the offer is something that's likely going to be really, really high. But let's flip this. Because if it is true that venture capitalists have a sole incentive of wanting to have their portfolios be positive and therefore behaving in profit incentive mechanisms, then it's precisely on our side where they are forced to leave before these kind of actors can come in, that things get a lot better. Because you can choose things, for example, such as an IPO as the company which is selling to the public, or you can simply choose to keep your shares internally, or you can simply choose, for example, to have a merger and acquisition with another company. The weighing here is simple. If it is true that there is a probability and it's a non-zero chance that you sell yourself to Facebook or Meta, this is something that is much more likely on their side when a percentage of your shares, be it 20 or 10%, is owned by people that solely look at how much money they can make of this company and how much you can treat it as a cash cow. If you want to preserve this thing, and this is a valuable contribution from CEO, we are explaining how we can fulfill this to much better levels. Sure, opening. 3, 2, 1, no. Okay, closing.
Sorry. The extension is that when you give up Grab shares, you will invest in 10,000 more risky, obviously flighty companies. Why will you bother to start investing in these companies when the risks are so high and the returns are so low to begin with for these companies to grow?
So this is the tension with that POI in your case, right? Because risky companies are the next big AI companies that you claim. Risky companies are the companies that you don't know the probability of success. So if you claim that you are investing into them on your side, then they must invest them onto your side. If not, it's just a framing of convenience to like elevate the OS burden. Second thing I want to talk about then is on the importance of innovative ecosystem. We say 3 things to this. The first is that we don't want capital that is just lying around without much ROI in terms of the ecosystem of the market and the economy. The second is that we want to surge innovation. The third is that we say venture capitalists typically do things to stifle innovation in the long run. They say to this that, well, not much, but at number 1, it's better to keep it within the company solely because this allows for better growth within the company because you have more money and more marketing, for example, and that they have more specialized knowledge and therefore they have better understanding of things. I guess that this is the more charitable take on the bookkeeping analysis that comes from opening opposition and the take of closing opposition. Why is this problematic? Number 1, because simply having more to spend does not guarantee the kinds of specialized knowledge that is required under R&D. Number 2, because the incentive typically isn't in R&D if you already have a fairly decent product. This means that if it is true that the innovation and development of these companies are really, really important, it is precisely here that you stifle these things. The third is to concede certain parts that opposition bench is correct about. Opposition bench is correct that Scrub Daddy needed logistics to be able to sell its product to the American public. But the problem is that there is a cap on that extent. The weighing here is simple. There is a cap on the extent of how much you can sell things, for example, in terms of market and your presence. But there isn't a cap on innovation. There isn't a cap towards how much you can grow as a company and how much your technology can expand upon. This is precisely why we talk about the ecosystem of innovation becoming better. The last thing I want to talk about very quickly is whether we can still enter the market and whether overall market conditions are going to be better. We say that monopolization is prevented. They say that monopolization is continued via CO. The reason why we can beat CO on this is that we give you the exclusive pathways to explain how monopolization can be taken apart, how VCs can relinquish hold of a company and invest in 2,000 other companies. Therefore, then this is more incentive for this to happen in the first place. We're beating CO very clearly because we're explaining why monopolization isn't as serious as they claim. We beat opening half because we explain how this benefits not just to one company, but to a multitude of companies within an existing ecosystem. For all these reasons, closing up.
Thank you, Gab, for that speech. Calling on opposition to end the debate. Here.
Am I both audible and visible?
Yes, you're both audible and visible. Yeah, I think OpWhip does consent. They did flag out earlier that they're unsure. Does that still apply now, Rushdoon?
Yeah, I consent to recording, don't worry.
Okay, amazing. Yeah, OC can proceed with the recording.
The issue with Naomi is she brushes off the POI that I ask her in terms of what are these incentives and do these incentives actually change? Because let's be honest, the incentives that these PE firms or these venture capitalist firms necessarily have are to make a lot of money and they're very pernicious in their ways. So they want control over these sort of companies in the way OG describes it to us. They want to ensure that if they don't like the structure of the company, if they don't like the direction of the company, they have the ability to go and do things like hostile takeovers and ensure that they have the ability to run the company in the direction they want to do. Why is this the case? Because they do a lot of investment into these companies. What does this investment look like? It looks like infrastructure investment. It looks like investing like, the knowledge thing that opening opposition talks about, but also like giving them directional expertise in terms of how they would run their businesses in itself. The response that Naomi has is just like, well, there are other reasons as to why they would want to go ahead and buy these sort of companies, and they would want to ensure that they maintain their stake. And the other reason that they have is just one, like they need a constant stream of money, and they feel that these businesses in itself will be profitable. But let's dial back a bit. The question is not, oh, do I sell off the business now after 10 years? The question is, do I invest into a business because I'm not sure at all that at the end of 10 years, I will have the capacity to own it in the future, which means to say it changes the incentives of why you would want to go ahead and own these companies, which factors very well into our extension, because that's literally what Umar tells you. The incentives now change to going ahead and doing things like pump and dump, because it means that there is more extractive behavior that is done. You cut costs for increased amount of profits, which harms employees, which harms innovation, which harms these actors in itself. The second thing that they claim is just, oh, we need to do IPOs, and these IPOs will increase transparency. I think a few responses. The first thing is there are other ways to increase transparency. Many governments force you to have EIAs or financial audits to submit to regulators. But the second is, if the company is not ready yet, forcing a premature IPO, as Umar explains to you as to why in many of these instances this would exist, means the company is likely to be undervalued, and this hurts shareholders, this hurts employees, etc. They never really explain to us as to why at the end of 10 years is actually having this IPO in itself the best possible option to go into ensuring like transparency and ensuring these companies in itself would grow and prosper. Because let's be honest, if like these venture capitalist firms figured out that they're going to be losing control after 10 years, there are other things that they would be doing in order to ensure that they have control over these sort of companies itself. But at a point of time, they realize there is no such measure, because literally OG says fiat. That is the time they want to sell it off, which means to say OG does not give you one good reason in terms of why these companies would still, these venture capitalist firms would still hold on to the companies that they're necessarily talking about. But the second thing that they claim over there is just like, well, we want to ensure that like there is more amount of like investment into, oh, this is closing government, by the way, which is the majority of the closing government extension, which is what I'll segue into, is you want more amount of investment in different sort of firms and different sort of like industries in itself, especially risky industries. And the first observation of there is just like OO's POI kind of takes it out. Like, why would these companies be willing to invest into risky companies? I'm unsure as to why that is the case. But I think the second thing to note about here is just like, it's just unclear in terms of like whether or not this investment would actually be good. Because if the nature of investment is to ensure that we grow it to a specific point of time, but we do not have long-term incentives to insulate these companies from all sort of risks, then there is the potential to dump them at the first opportunity in itself. Now, closing government is like, oh, but this recessions may always not occur. One, like recessions, there's a very high risk of recessions to occur. But secondly, our case is path independent from that, because there are other instances at which you may like want to sell it off, which are not necessarily economic recessions. It looks like, oh, maybe there's a hit in this specific, in the hospital industry or stuff like that, which means to say there are other instances because of like other issues that exist in terms of like products like being screwed up in itself, where you would want to go ahead and ensure you sell it off, which means to say you can't necessarily make the claim that like, oh, like this will be in the minority of situations. Before I move on, closing POI. Yes. Opening?
Yeah, so the vast majority of startups already have ownership sold in the 10 years, so your harm is very small in the trade-off. But our fiat model preserves the long-term investment incentives because you can hold stock and profit just without voting rights.
Yeah, but the question is, what is the value of your stock, especially after you've done a thing like an IPO in itself, right? It really dilutes the capacity for this firm to really get any sort of long-term investment, especially in terms of like, oh, when the direction of this startup goes very different to like what you think like the direction of the startup should go to, which means to say it's not really clear why you would want to make all this initially great investment, or why you'd want to go ahead and like build this like thing in a long-term capacity, because you know this will never be your own. You know there are a lot of shifts in the markets in itself. It's not really clear how you explain that. But the second thing CG says, oh well, there's a capacity of these companies to be salient because, well, now they have more resources. But the question is like why specifically would these resources be so significant with these specific startups in order to ensure that they hold up against like large big companies like Amazon or other sort of like notorious PE firms in itself who'd want to go ahead and like buy out these companies in itself? So even in the worst case scenario on site closing opposition, where they have some level of marginal capacity, which they never really explain, because as I've explained to you, VC firms have pernicious incentives to restrict and pump and dump. The idea is this: the risk of you being acquired by these firms is significantly higher, which means to say, even in the worst case scenario, like the harms that exist to these sort of firms in itself, the potential of harms is significant. Why do you ought to value this against anything opening opposition provides to you? Because I think opening opposition's claims are rather generic in terms of like hurting things like talking about risky investments. But the question is, why are these risky investments good? Because most of these risky investments fail and waste money. You can reprioritize this in better, more secure ventures that we talked to you about, which means to say it's not really clear why their impact is something that we ought to prioritize. But secondly, their impact is also locked towards startups that like are very vulnerable and need guidance. Our impacts are more broad-based.
Thank you, opportunity for that speech. Debaters, you may now cross the house. And please leave the room as we'll do the deliberation here.
Thank you for the debate, everyone.
Thank you so much for the round.
Thank you.
Thank you, guys.
Thanks.
Hi, I'd like to check again. Is everyone here okay with deliberation being recorded?
Yep.
Yeah, sure.
All right, great.
Are all the remaining individuals in this call from OC, including OHS?
I do not know who OHS is. I do not think they're OC.
Okay, would it be possible to kick them out of the
Yeah,
room?
I'll just kick them out.
Thank you. Okay, Shaurya, Srishti,
Oh.
I've started, I'm going to start 1 minute, and in that time period, we can finalize our initial verdicts.
Yeah, in the meantime, I'd like to redact consent for recording the deliberation.
Okay. So that means you won't be able to record the deliberation entirely because there will be parts that are missing. Yeah, that's definitely okay. OC, are you there?
Yep, I already removed them.
So Shaurya just redacted their consent to be included in the deliberation. So
Okay.
seeing that there will be a panelist missing, I don't think it's going to be a productive recording to have if we still record it.